Welcome to this episode of Property Banter. My name's Michael Ležaja, and this episode is a cracker. We have Josh Deckart from Zappio, and we're talking about property portfolio planning, how important it is, and we're going to give you 3 scenarios and show you the difference in outcome of all 3 layered across each other. This episode is really going to highlight the importance of portfolio planning and how it affects your property portfolio and your outcome. Let's go. Welcome, Josh.
Hey, Michael. Good to see you.
You too, buddy. So today we're going to lay out 3 portfolios with the exact same purchase price to show everyone at home, how they have 3 separate outcomes.
Let's
go.
Really excited for this one. Yeah,
let's go.
This is awesome. We've got 3 scenarios today that we want to play out. We haven't gone into depth into a personal situation, sitting down in a client-facing sort of approach, but we really wanted to deconstruct 3 sort of methods to getting to an end result and sort of compare the difference. The common one is in your own name versus trust. Obviously, it's a pretty big topic at the moment. And then we obviously, we've introduced some granny flat additions and a bit of commercial in there, just so you can sort of see what you can do and what you can't do. Pretty simply, to be honest. So we've kept the purchase prices the same for the initial acquisition, and I'll sort of deconstruct it now. We've got rent vesting is the first one we're going to go through. Individual name, 220 grand household income, 140,000 in savings, and then $2,500 a month savings rate. This is a common sort of scenario, so we don't want to flex it too much, but we just go for the common one. In the scenario here, we've got an equity and a cash flow chart. We basically want to show the purchases. So this first one was a Mount Sheridan, $600K purchase, $630 a week rent. Pretty consistent with what we're seeing now. We have to put some assumptions in, and the assumptions in this instance, high pressure market, we're looking for a circa 10% return first year and then taper that off, so 8% and then obviously down to 6%, being realistic that markets don't truck along crazy results forever. Conscious of that, we want to reflect that in our modelling. We've done the first purchase here, as you can see, in Mount Sheridan, $600K, 1st of September 25. We don't own any other properties at this point. This is basically the chart that identifies what we're doing, how we're tracking from an equity, debt, and a portfolio value standpoint. And we can also look at the cash flow, which arguably is probably the most important part, is maintaining your cash flow over time. Because if you don't have cash flow, you don't have any oxygen to survive, sort of thing. Yeah. So we want to maintain less than $2,500 a month, because that's our savings rate. We want to try and stay within. If we're spending $2,500 a month on the additional properties, we're at that limit of, we've got to survive, sort of thing. So that in mind, we've taken that into consideration, and we've sort of made 3 purchases over a period of, 4 or 5 years, which is realistic in your individual name, taking into consideration obviously borrowing and everything like that. In this instance, as you can see, we sort of get to a neutral cash flow position collectively in financial year 41. So it's a bit of a lengthy process. The reason why we had to drag it out is you've purchased 3 properties, individual name, we've got no borrowing capacity left, and we're like, well, what do? We've just got to let time do its thing. Rents increase, values increase, and we get to a point. But, as you can see, over 50 years, it would be okay, but over 30 years, we're not really getting crazy cash flow, to be honest. This is a bit of a concern. Everyone wants the positive cash flow. Just got to get a little bit more creative in the strategy. So what we did is we then layered over another strategy, which was, okay, let's do a sell down. What happens if we sell our portfolio down at that point in time, or a point in time, and then sort of transition to commercial, which we hear all the time as a strategy. And this is more reflective here of, here's the equity. We've built and built and built. We've built the asset base up. We've sold, so FY41, same point in time that we went neutral in the previous example. We've now sold all our properties, and I can show you how to do that in a sec, the selling down of properties, but we sold all 3 assets, got some cash base. Let's try and stretch that as far as possible into some more cash flow focused assets. So that's what we did basically, and more or less the results on a cash flow front, you can start seeing that they're starting to increase. So what we'll do at the end is we'll compare all 3 scenarios, and you'll get a bit of an idea of, that capital growth versus cash flow sort of scenario where you can sacrifice one, sacrifice the other, but you can also get a combination of both if you plan out in the future and make sense, right? So yeah, this is crazy. So we've got 3 properties, we've sold them down. We now transition to commercial, and then we've got a bit of a spike, as you can see, a bit of a spike here in the cash flow, and then we're sort of trucking towards 100,000 net and net cash flow, because in this game, what's in your bank is what you spend. We've got to be conscious that we're not overstating, you know what I mean? We've got another scenario. So this was all purchased on the similar dates to the first scenario, and then we sold and we bought a commercial at 3.5 million. We had a generous yield on that of 7% net. Makes a big cash flow difference. So we'll go into the last one. So the other one, is here, and it's rent vesting with trusts. Everyone wants to talk about trusts, and it's unlimited borrowing capacity, all that sort of stuff. When planned correctly, you can manage all, your borrowing capacity, you manage, what your portfolio looks like in the cash flow, but you really need a system to model it out. It doesn't make sense to not model it out. So what we did here is we did the same thing. We actually purchased the 600K first purchase, the 600K on the second. But interestingly, when we transitioned we did the first 2, we added granny flats after we purchased the first 2 properties. And the reason why we did this is you want to prioritize the big asset first in a growth area and then add the cash flow later. Whereas if we had have gone and purchased the first property, added a granny flat, you sort of start using capacity unnecessarily, and it stops you from getting into another property, although the cash flow is now getting better. Does that make sense?
Yes.
So I guess the thing is, we really want to highlight that the order of events is very, very crucial in how you do it, because you could get the same amount of granny flats, the same amount of entities, the same amount of properties, but if you do it in the wrong order, you can actually slow progress. So we've consciously bought 2 properties and then gone back and added granny flats to them when we had less capacity to do it. And you can see the difference here. So I want to show you the individual investment a little bit negative, and then we added the granny flat straight away, and it cranked the cash flow up. But collectively across the portfolio, we really supercharged what I would say is the trust is self-servicing now. We've supercharged that process because we've added so much rent, it's positive cash flow. So that's the name of the game, right? Negative cash flow, trusts are pretty bad with the cash flow. Let's introduce rent and increase the cash flow as fast as possible. And then we've got oxygen to survive, we can manage it, and we've got high growth assets. So we did this, and then we actually used the term cloaking, where we've taken your borrowing capacity, you've got multiple levels of debt in those first 2 trusts. And now that they're self-servicing, we've used a lender that would exclude those 2 trusts and basically bought a property at 1.2 million in FY32, because we now got a majority of our capacity back. And that takes us negative again. So what do? We added another granny flat, right? And this is the key, is when you start, playing around with structures and financing and then great properties, have a good team of people, we can get good results. So I guess the thing here is we want to compare these 3 scenarios, noting that the first one here, we've got a rent vesting scenario, which is the standard individual name, just the multiple purchases. Then we've got to sell down those assets, buy a commercial. And then we've got the rent vesting and trust, which we use creative. We've got a bit more creative, granny flats. And I just want to show you, once this loads up, it's pretty crazy, the difference. So, we've got the rent vesting and trusts, and then the sell down portfolio.
Yeah.
We sold down and bought a $3.5 million asset and had 5% growth forever. So that's pretty good, right? And great cash flow. But then the rent vesting scenario that we used trusts, we had granny flats. And if you look at this, it's quite interesting. Like, the difference between the cash flow at the end is actually a little bit different, but noting that they're complete different strategies, it's pretty crazy. So this is the cash flow right now, and we're looking at, we can go over a 10, 20 year or 30 year or 50 year timeline. But like, if you look at the difference here, the rent vesting and trust is actually not that far behind commercial when we get to the 30 year mark. Like, it's 20 grand difference, but they're completely different strategies, right? Commercial, we transitioned to positive cash flow financial year 41, whereas we did something completely different on this. Now, to layer that up, we could sell down our granny flat trusts and ones and go into commercial again if we wanted to. But it just goes to show there's not one size fits all. There's thousands of strategies. Yeah, people sell you on one particular strategy, but each person's in different risk appetite, different cash flow situations.
Different outcome. Everyone's looking for something different.
100%. And I think the biggest thing that I notice is that I know that there's this big misconception that trusts are super expensive and you should always go for trust. That's not true. And on the flip side, purchasing individual name to get negative gearing benefits is like another big common one. Now, I want to just highlight something in these charts that a lot of people don't really realize is that when you're using trusts and obviously get advice around this from an accountant, but if you look at this peak, you actually end up, because we've used these trusts, we've actually ended up peaking out a little bit higher at one for a few years. The reason why this is because you can actually carry forward losses in a trust. So the cash flow is worse to start off with, but then you get credits later on. So this actually ramps up quite fast.
Yep.
Now, strategically, yes, you could argue we can sell a property around about here and then build the portfolio into commercial, and we've got a larger asset base, and that would expedite the growth and would arguably end up with far higher cash flow than just pivot to commercial. I guess my point is, sitting down and actually trying to figure out the differences between the two make a big difference.
100%. That really highlights the differences between all the different strategies available and why your portfolio plan is very, very important along with your end goal.
Yeah, 100%. And it's even like the simple things, right? So you want to put a 7% or a 6% growth rate over 30 years. That's a standard approach. But then having, the knowledge or finding people with the knowledge that can turn around and go, hey, well, actually, we're using like advanced data and analytics to go and highlight areas that we think will have 10%, 12% growth over the next 12 months. When you model that against each other, like a 12% versus a 6%, the first year of growth, mate, the importance of getting initial upfront growth and then compounding is crazy. And it goes to show, like, in portfolio planning in general, if we cut the timeline down to purchase and stretch yourself using higher LVRs and weather the storm a little bit at the start, when you start modeling it out, it's like, a wonder of the world. Like the
LVR is the supercharger.
100%. And I think it's not until you visually see it too. A lot of people are visual learners. So you can explain to people all the time, hey, this is how it works. They don't really truly understand. So it's just about getting the nuts and bolts in order and comparing them and figuring out what's right for you. You may know, you may not know. You might be right, you might be wrong. But until you actually figure it out and plan it, you don't know what the outcome is going to be. And you might need to do more purchases. You might be good. Yeah, there's so many options.
And those initial purchases, the sooner you buy a property in a good data set area, the sooner you get that uplift to be able to build out, right? It's
100%.
And until, like you said, until you've seen it, you don't know. Now, I've lived that where I remember having 6 properties in 2010, all not moving up in value.
Yeah.
So great position to be in, but nothing's moving. It didn't move for many years.
Yeah.
And I've seen the importance of how, I've seen how Queensland moved rapidly at a certain point, and I sort of missed that, whereas you could have kept on scaling. So
it's interesting too, the whole cash flow versus capital growth conversation, because you got to manage cash flow. Like, cash flow is oxygen, and we can't stress that enough. You need to manage your cash flow as best as you can, because you can technically stress yourself too far. Like, you can stretch it and then you get into stress and then you force selling assets. You do not want to be in that position. Sometimes waiting's better. You need to identify, like, when am I going through, like, if I'm saving $2,500 a month, that's $30K a year, right? Am I spending $40K a year? Well, you can only sustain that for so long if you've got buffers, right? So you need to really sort of map it out, what makes sense. But the cash flow versus capital growth it's an interesting one, because if you build solely for cash flow, like just purely just for cash flow, and you get zero growth, you do never have an asset base to have options. And that's the thing. You'll go across and you're like, I've got $200,000 of income. And then you get to a point in time, you're like, all right, well, I don't want the headache of 10 properties anymore. Let's sell them now. Well, I've made no money. I literally have nothing to show. If I sell them, what have I got? It's particularly if you're using interest-only loans. If you're refinancing all the time and you're not paying down the debt, you end up in a really sticky spot. You've done all this hard work. And so I guess it's that balance between fundamentally sound, good data set areas from the start, high pressure, lots of uplift. And then if you can introduce rental yield, or you find, sometimes you can find great deals and it's like, 5.5% gross yields or opportunity to value add, all that stuff.
You can find cash flow in data set areas.
100%.
It's out there.
100%. Yeah, 100%. Yeah. And I think that's a misconception as well. So like, this area is only 3.6.
You have to choose one or the other.
Yeah, 100%. Yeah. And
That's
it's not
a
like that.
No.
But with a tool like this, you can actually manage that. So you get 3 scenarios and you say, look, our max negative cash flow we can handle is 30K. All right, well, let's play around with if I did this versus I did this, if I did this. And then you've got 3 robust scenarios that you've managed the cash flow. Now, what's the end cash flow when I want to retire? What's the capital value to transition? And I guess then you can plug in SMSF and stuff. You can actually join the 2 portfolios together. You can build an SMSF one out using the sneaky stuff, and then you can plug on the normal portfolio.
Yeah.
And then it starts getting pretty sexy.
The amount of detail is what's really struck me here with this platform that you've developed. It's absolutely amazing with regards to how many layers and how in depth it goes.
Yeah, I think interestingly, you have to make assumptions. There's no way you can get around the assumptions based, I want to see what's going to, that's modeling, right? That's forecasting. But we need to remove as many of those assumptions as possible. So when we're bringing in brokers, for example, we want to give access to brokers. So the brokers can look at this, the system and say, the system's saying you can borrow 1.2 million, I can stretch you to 1.4. Okay, let's adjust that. So it's those little nuances. We're not holding you back. We don't want to overestimate. We don't want to undercook it either.
Yeah.
But there's emphasis on jump in, track your portfolio accurately, do portfolio reviews, assess where you're at, because your plan will change dynamically. You get a massive pay rise or a bonus. You can buy more property, go in there and play around with it. What we actually did is we've created it so there's a free tracker, portfolio tracker, which is really handy because you can see where you're going and what you want to achieve. And it just ends up being quite a interesting thing in your pocket that you can look at.
It lets you actually visualize it.
Yes.
As opposed to just going, I'm just going to buy a heap of properties and however it works out, it works out. This is actually shows you.
100%. And because we use the live tax tables and stuff like that, if you're using trusts or whether you're using your individual name, companies coming soon, it gets to a point where pretty much if you put in the right expenses for your property that you actually own and everything, you can literally go down and check out the cash flow statement with modeling in advance, which is pretty slick. However, ultimately you need to keep track of what you got and then you build upon it. And at any point in time, you have a fundamental change in your portfolio, you need to sell, your wife's on maternity leave, whatever, run the scenario, change.
Review it.
Yeah, 100%. It's just got to be dynamic. There's no static plan. People say,
Plans change.
Yeah, 100%. Yeah, 100%. And you might get crazy results. If you've got a good team, good accountant, good buyer's agent and basically a good broker, three pillars to getting everyone cohesively working together. Yep. So, the 3 circles, the finance, the property and the accounting in one sort of neat little bundle. Not playing tug of war. They're all in there working for you, chipping in, and you can scale a portfolio. Just need to plan it.
It's super important, 100%. Yeah. It's super important that everyone understands, even CEOs have, a legal team, a HR team. They have, they have all their specialists in their fields working underneath them. Yeah. You're the CEO of your own journey, essentially, right? 100%. So utilize all those experts to put you in the best position and in the end, get you the best outcome.
Yeah, 100%. And I think that the interesting thing about it is you need to treat this as a business. So have a business mindset. Would you go and not run forecasts on your revenue and your, and what your profit's going to be in a business? Well, if you don't you don't succeed. If you don't know what your bottom line is, you don't succeed. Yep. Property investment is exactly the same. But how do you model that out? And that's the tricky bit. So that's why we've got it. So it's all modeled on financial years. What's your cash flow? Play around with it. Yep. Just come out with some crazy answers. Flex it. Try and shoot for the stars. But I mean, it's all possible if you plan it out and you'll understand the limitations and bottlenecks of your own situation. And that's the thing, like what's stopping me now is like, well, I'm not structured correctly. That's the most common one you see, right? I've got no borrowing capacity.
Common.
And the frustrating thing is I bought a cracking property and I bought it in the wrong entity. I didn't get any advice. No one helped me, but I bought a cracking property. If I want to progress, I have to sell that. Or I sell it to myself and then I pay stamp duty and capital gains tax, and it's just a very, very, very expensive sort of scenario. Easily avoidable with a great team. But you can run that, PPOR, changing scenarios, so changing use of property, so PPOR to investment to PPOR.
Yeah.
How does that affect me? Rent vesting, all those scenarios, sky's the limit. Just run it. Scenarios. Yeah. Just run it. Yeah. So, but yeah, it's been exciting. It's good to see visually. There's even things that, penny drop moments. You're like, oh, that's how it works. You know what I mean? So it's great.
It's a fantastic platform. So now here's a common scenario that I come across very often is an individual, let's call them John from Sydney. Yep. They've got a, principal place of residence down in Sydney. They're not looking to scale a 10 property portfolio or run the 200K passive income. They just want to pay off their principal place of residence that they still have a mortgage on. Yep. So what they're thinking is to buy an investment property or two in a good data set area and pay out obviously or cut their home loan down and finish that off essentially. So could you show us?
100%. Pretty common scenario now. Obviously, not everyone wants to have 10, 20 properties. It's great. It's awesome. Yeah, I think there's a growing demand for paying off your principal place, particularly in places like Sydney if you've got a huge income. But obviously, then we've got another scenario which is sort of building on what you said is people buying houses now. They're going they can only go to 600, 650K. They've got to buy something, but they also don't want to be, that mortgage stress. So they say, well, what can I do? How can I expedite it? So we've come up with a scenario here. Basically, we've purchased a property for 650K at 90% LVR, pretty high, $585,000 principal and interest for 30 years. Pretty standard scenario. We've gone and intentionally, it costs you nothing in theory to hold your principal place. Your savings are on top of. So our savings rate is still $2,500 as if we were building a portfolio. What do you do now? You've got capacity, you might have some equity. The scenario we're running now is we've got a property that we're purchasing now, PPOR right now. We're new to the market, we're buying what we can, right? We might have capacity, but limited deposit, so we've gone in for 90%. We wait just over a year or two and we see if we've got a little bit of equity plus some, the $2,500 a month savings, plug that together, try and buy an investment property, a little bit of cash, a little bit of equity, 90% LVR again, just to stretch, as much as we can go. And we've purchased another $600,000 property. Now, the interesting thing here is that people, you could look at it like, they've gone in and actually doubled their stress. Well, not really, because we're holding an appreciating asset in a good market that has high pressure. We're relying on capital appreciation to outpace our savings. There's really two options. You get the savings, you stick it into your offset, it offsets a bit of interest and you pay your principal down a little bit faster, or you stick it directly into your loan if you want to use a redraw, or you get the $2,500 and you stick it into a shortfall on a property in a high pressure market. Obviously, you want to reduce the amount of negative cash flow. That's natural. But by doing that, this is what happens. This is crazy. So we've got two investment properties. I've just put in random names here for the investment properties, but 650K. We've bought a property. Let's just call this property Mount Sheridan, like our previous example, circa 5% gross yield. Now, what we want to look at here is that at any point in time in the chart, we want to just highlight these blue lines here is basically our negative cash flow from our PPOR, heavily negative cash flow. We're not looking at that right now because you're going to pay that anyway. We're looking at using the $2,500 savings above our payments to buy an investment property. So basically, this is the property modeled out, negative cash flow. The peak negative cash flow on the investments, negative 7,200-ish. And then it takes quite a long to get neutral, but that's not what we care about. We care about the capital base increasing. So what I want to highlight here is that at any point in time, like at this point in time, FY28, we've still got $546,000 owing on our property. That's, we haven't really progressed too far. But, by buying this additional investment and letting it grow, this metric here, which is after our PPOR is paid off, at the point in time, do we have a deficit or a surplus in cash? So we just click along here and just identify, if you see this number here, in FY33, there's only $300,000 left off if we sold our investment property. All the calculations are done, CGT paid, fully net in your bank account. And that's really important. This is not just an equity gain. This is a proper calculation to say, based on your income and based on your current rate of tax, you're going to end up with net proceeds after sale of, X. So in this instance, we can really start honing in and say, look, if there's a surplus of cash, so this is a positive number, this is currently negative in FY37 of negative 18 grand. We're getting close. We've got 18 grand left on our home loan if we sold our investment. And then the following year, the growth has started outpacing. So you look between FY37 and FY38, if we were to sell our investment property in that year, we have just paid our house off. So we've gone from not having property to buying a PPOR in necessity, and we're doing P&I. We've used the extra capacity after about 12 months or 18 months to go and use a little bit of equity, a little bit of cash, bought a high pressure, good data set areas, buy the property, an investment, and then we waited 10 years, sold that property, paid off our PPOR, debt free. So at that point in time, you're now in the driver's seat that your house is fully paid off, and then you can start exploring, use the equity. Now it's a fully deductible for future investments, but you know your house is paid off, you're set, you're financially, that's the goals, and the rest is passive income. You can just basically start dialing in further investments for passive income. But this is a really common scenario, and I've actually probably the scenario that we've run is an interesting one because we're only purchasing our PPOR now. Many people already own it, have already paid a chunk of their PPOR off. So that would, the timeline would shorten. You can expedite this, add another property if you've got capacity, buy another property so you've got two. Again, compound the growth, sell down one potentially, sell down two, and then you're square. Yep. So it's pretty powerful.
Mate, I like that scenario.
Yeah, it's great.
But that's a fantastic outcome and something that I hope everyone at home got a lot from. Josh, thank you so much.
No, thanks for having me.
I hope you enjoyed this episode of Property Banter. Please like, share with a friend, and of course, subscribe. And until next time, take care.